enable.
Hello and welcome to NSE FinWiz Season 6 powered by CNBC TV 18. I'm your host Gautam Srinivasan, and as always we continue our journey to enabling employees at various offices to understand concepts behind financial planning and wealth creation. Our next pit stop is in Pune at the Global Development Center of a large multinational IT services provider, Syntel. So let's take a look.
Syntel is a leading global provider of integrated IT and knowledge process services. The company assists its clients accelerate their digital journeys by helping them with ways to master agility in their organizations and hence improve their performances. With around 120,000 employees in 73 countries and an annual turnover of 13 billion euros, Syntel has created a niche for itself the world over. The company steadfastly believes in delivering the scale and flexibility required for the digital age. This week, NSE FinWiz is at Syntel's campus in Pune to engage with the young minds assembled there on the theme Invest in Yourself, Your Path to Prosperity.
Financial literacy is very important, especially in Syntel, where we have a very young workforce, and it's extremely important for them to be financially literate, to be able to meet their life skills and their financial individual goals. And just like we encourage them to upgrade their skills in digital and technology, I'm so happy that we are encouraging them to become financially literate.
Financial literacy is something, a roadmap towards your financial investments. Where do you want to see yourself down the line after 5 years, maybe 10 years, with of course your short-term goals and long-term goals. We have multiple plans available, options available in the market. It's just about choosing the right option at the right point of time.
As a working individual, financial literacy for me is all about having knowledge and skill so that I'm making effective decision of my available financial resources.
Wealth management is important for me to be able to best utilize my money to achieve my short-term and long-term financial goals. It is also an opportunity for me to take an insight on the expenses, savings and investment patterns that I do for so long, and how can I establish a ratio between my expenses and savings to build my wealth.
Welcome to NSE FinWiz Season 6 powered by CNBC TV 18. Invest in yourself, your path to prosperity. That's the ongoing theme of this series, where we look at newer and better ways to learn about how to make your money work even harder for you. Financial planning and wealth creation. That's the focus. Our next pit stop is here in Pune at the Syntel Development Center, where the employees are all eager to ask their questions to our financial planning experts, Ankur Maheshwari and Firoz Aziz. Thank you so much for joining us. We look forward to a very interesting exchange of ideas. So let's start on the broader theme, which is about, investing in yourself. Now, whenever it comes to investments, people sometimes back down because they hear so many terms and they wonder what that's about, and they feel that it's too complicated for them. Now, when I did a poll earlier with the audience, most of them raised their hands when it came to investing in funds. But a lot of the time you hear, alpha generate. Let's see how much alpha our investments have generated. What does that mean between alpha and beta? Clarify some of these terms for our folks here.
I think all of us have a basic expectation in terms of returns, and that's normally around how the index has done. So what we normally see is how the Sensex has delivered, how Nifty has delivered, say in the last 1 year, 3 year. And when we invest in a mutual fund, what we typically expect it to do slightly better than the index. The return which is generated over that index is known as alpha. And that is why we mostly invest in actively managed funds, where we think the fund manager will be able to pick good stocks which are able to beat the underlying benchmark. That's alpha, and that's what a fund manager is aiming to do in his fund.
In terms of assessing the returns from a fund, as to how to know when your fund is doing good or not, what are some of the basic parameters that the folks here should know about?
Equity markets don't give you returns in a linear fashion like a fixed deposit. They give you in chunks. So you have to wait for those chunks to come. You can't be disappointed, point one. As long as you understand this, you will be happier living with a volatile portfolio. Point two, how do you identify a fund? Of course, there are several ways to identify a fund. One thing is consistent delivery of return, consistency, not high return, because all of us should aspire for higher chance of making money rather than higher money. So consistent performance. These are the two things you have to remember: rolling return and ratings.
It's almost tax season right now, so people would be wondering what they can do about saving taxes, but at the same time looking at investments. So you have tax saver equity funds, ELSS, NPS, all these options. So what are some of the good options to save, tax and invest?
So I think we're in the most appropriate month, and March is the month where most of the tax saving, tax planning happens. So this question is getting discussed as the most appropriate time. Like you were saying, Gautam, there are multiple options to save tax, right from PPF to ELSS to insurance policies and multiple other options, right? There are different options, and each option has a different set of customers or a different set of investors meant for them. For people who do not want to take any risk, I think PPF is a fantastic option. It offers you guaranteed returns. It has no tax liability, so it's a brilliant option in that sense. For people who are looking at some risk exposure but are comfortable holding for 3 years and more, I think ELSS is one of the best options, because historically, we've seen over multiple years that if you hold equity as an asset class for long term, it delivers probably the best returns. And therefore, ELSS turns out to be one of the best options that an investor can look at. You need to look at what risk appetite do you bring, what time horizon do you bring. Then there are tax saving FDs which have a lock-in of 5 years. If you have 5 years with you, but the rate, the return expectation then should come down, because FDs are typically not the most efficient instrument from a post-tax basis. So there are different options for different investors, and one has to look according to his risk appetite and time horizon.
Okay, and another common question, Firoz, we get is, what's a good way to hedge our bets? What is some of the do's and don'ts when it comes to creating a good hedge for your investments?
When it comes to hedging, hedging is to remove the risk or reduce the risk of a certain activity. Equity is going to be risky. One conventional way to reduce risk is asset allocation, where you allocate a portion of your money into predictable assets like debt market, where you will at least get 8% return, and equity can also deliver -20 in a particular year. So in 3 years, if equities were very bad and they delivered -20, debt would make you 8% every year, and still your portfolio as an overall will not lose money. So that's one conventional way of hedging. Two other ways of hedging, which are not so conventional but still accessible, is something called a LEAP, which is one of my favorite instruments. It's been in India for 10 years, 10 and a half years. LEAP are long-dated insurance kind of policies on Nifty. So these are the two methods.
All right. On that note, we'll take a very short break. It's been a very interesting exchange of ideas, broadly talking about investing in yourself, your path to prosperity. When we return, we'll be talking about investing in equities, the risk versus the long-term benefits. Stay tuned. CNBC TV 18. Welcome back to NSE FinWiz Season 6, powered by CNBC TV 18. Now, in the previous segment, we broadly spoke of investing in yourself, your path to prosperity. In this segment, we're going to talk about the topic of the episode, which is investing in equities, the risk versus the long-term benefits. All right, Ankur, let's start with, in identifying risk appetite. How does the progression work for a long-term investor who also has to make short-term decisions? How do you identify what sort of risk appetite you are comfortable with?
I think there are multiple quantitative and qualitative ways in which one can identify the risk associated. If I have to look at some of the quantitative parameters, if you look at an equity mutual fund, there are few ratios, like say a Sharpe ratio, like say a Trenner ratio, like say a beta, which give you an indication of how volatile the fund can be or how much risk is the fund taking to deliver that return. Second, I think, is a matter of one's own individual risk appetite. If I am comfortable taking that risk, that markets, if they go down, I am fine to see that red in my portfolio, and which is sharper or higher than the index, then I am okay to take small cap, mid cap exposure in the portfolio. But if I am more comfortable looking at safety, more comfortable not looking at too much dip in the portfolio if markets were to correct, then I would rather prefer large caps in my portfolio. There could be another approach where I take a balanced fund or a balanced advantage fund as a category, which has emerged as a very, very popular category where the fund automatically adjusts the asset allocation and tries to protect on the downside. So it's a combination of all these things which I would say is important for an investor to look at.
All right, and Firoz, on the passive side of investing, index funds are gaining in popularity. But again, the question comes that you see options within index funds as well. Whereas the premise is simple. Index goes up, fund goes up, index goes down, the fund goes down. So how do people choose between index funds?
In India, you should not look at index funds. Index funds, to define it for the black, or to fill in people who have not understood it, index fund is saying that no human being, no fund manager should use his mind. You should just replicate an index, a platter of stocks. And fund manager should not try and do his own. So the fee is less. You are just replicating Nifty, for example, which is the largest index in this country, Nifty. So index funds in India are 10 years away, because if you use a human being, history says, last 10-year history says, you will do better than an index. When it comes to choosing index funds, choose the largest index, Nifty or Sensex funds. Also choose a mid-cap index fund. I think you should stay away from small-cap index funds because they're not a good representation.
Better be ready for the ride if you want to, get the returns. So let's take in some questions from the audience on this topic of investing in equities, the risk versus the long-term benefits. The first name I'll call out is Hriday Chalani.
My question is what are the best investments for next to 5 to 7 years, considering I can take high risk?
If you have 5 years with you and you are open to taking risk, I think firstly, like we were just discussing, decide on the asset allocation. While you are open to taking risk, but it is important to understand that whether you want to go 100% into equities or do you want to have some small component in the portfolio which you want to always keep as a safe or a limited volatility kind of instrument. And after that, in the equity, again, you decide on the kind of beta that you want to create for your portfolio. If you want high beta, you want to take more risk, go for mid cap, small cap. If you want to play it safe, keep more large caps. The question is that there are too many events around the corner. It could be election, it could be the global trade war which is going on. It is therefore impossible to predict the direction of the markets. What we can do as an individual is, one, decide the asset allocation, and two, in that asset allocation, then choose the right product. That's very important. Because even if you look at the large cap category of mutual funds, there are probably around 40, 45 large cap mutual funds. The idea here is that if I am in the quartile 1 kind of funds, I have, sort of done a good job for myself. While there is no fund in the history which has consistently remained the top fund, every year you see a different fund coming at the top fund, things like that. But broadly, if you stick to quartile 1 funds, I think that's good enough. So asset allocation followed by just selecting the right fund. Do not worry where markets are going. You can only decide which products you can choose. You cannot decide how markets will behave.
All right, I hope we've answered your question. Thank you so much for asking. The next name I'll call out is Srijan Sanhadya. If I could request you to get up.
I have some small goals. Like for 5 years, I have such goals, 10 years and 15 years. So I have some money currently at my account. So what should I do? I should do a SIP, or I would invest a lump sum amount for that.
See, if you have lump sum money, you have to make lump sum investment, to my mind, because you have different goals, right? You have a 5-year goal, 10-year goal, 15-year goal. So to answer your question, lump sum. As long as you've got your strategy right. What do you mean by getting your strategy right? Your asset allocation should be correct. If you are just buying a product in a haste, then you should not make lump sum. As long as your strategy is there, you should do lump sum investments. Point 2, in the contemporary situation, where should you be investing? To my mind, I would say equity is going to be the asset class for the next 5-7 years. And the second point, which I want to make a larger point to everybody, comfort. Am I comfortable? Comfort is overrated when it comes to investments, right? Why should I be so comfortable? I need to learn to be comfortable with something. Ideally, it's not comfortable for us to come on a Monday morning. Na? You get those Monday morning blues. So be comfortable, stay at home, then you will not have growth. So you have to learn to be comfortable with your investments as long as you're not being irrational. The discomfort will pay off.
I hope I've answered your question. And on that note, we'll take another very short break. In this segment, we're focused on investing in equities, the risk versus the long-term benefits. When we return, the floor will be open to the employees here at the Syntel Development Center to ask any question that they have on personal finance and wealth creation to our experts. And of course, to the viewers watching at home, you can stay updated with us on our website, NSEFinWiz.com, and of course our social media handles and Facebook and Twitter at NSE FinWiz. Keep watching CNBC TV 18. We'll be right back. Welcome back. You're watching NSE FinWiz Season 6 powered by CNBC TV 18. Well, the floor is open to the employees here at the Syntel Development Center to ask any question they have to our experts. So let's see a show of hands. Who wants to ask a question? All right. The gentleman in the third row.
I was just asking that if I am not investing in SIPs, so what are the sectors I can choose from the equities that do well in next 10 years? Say
it is important that we give allocation across sectors. One, because it is like I was mentioning about markets, it is very difficult to predict the same about sectors, which sector will do very well and which will not do very well. It is always important to have a balanced construct of a portfolio. Whether you look at sectors, whether you look at the market cap allocation, whether you look at the overall asset allocation, the golden principle in investments is always to maintain a very, very balanced view of your portfolio. So if you are looking at which sector to pick, you can pick a sector basis past performance, but you can't really predict if that performance will get repeated in the next 3 or 5 years. The best way I would recommend is look at a multi-cap fund, give fund manager who is the right expert who is managing your money the freedom to operate across different sectors and different market cap segments. Let him take that call on your behalf.
All right. The gentleman in the second row, I believe you had a question. You can get up.
My question is that I want 1 crore amount at the age of 45.
Being impolite, I have to ask your age. What's your age currently? So that I can do the arithmetic
30.
difference. 30. So you have 15 years to get to 45. So if you want to accumulate a crore, of course, you will have to start investing regularly. So systematic investment plan. You have to increase it on a yearly basis as your salary progresses. In 15 years, salaries in an Indian context becomes 3 times. Should your investments also become 3 times? They should. Sometimes we don't actually increase our investments enough. We just do an SIP for 20,000 and just leave it there. But your salary could have actually afforded a larger SIP.
I hope I've answered your question. All right, let's have one last question. The lady in the back.
My quick question would be, not everybody can afford a financial advisor or a wealth manager. So what would be your recommendation? How could we increase our financial literacy?
Very good question. Firoz, you want to take this?
So point 1, where can you get your knowledge from? Of course, electronic media is a very, very good source for us to learn investments. So electronic media is a very good source. Catch hold of a couple of personal finance shows and watch them on a consistent basis. Then coming to implementation, fortunately in the age of technology, there is technological platforms available at minuscule cost which will bring your goals down to actionables. Third is product selection using a platform like Money Control, which rates all the funds. There are thousands of funds available. If they can be rated for you in a comprehensive 5-star rating like hotels are rated, that's very easy for most of us to comprehend. So these 3 steps will get you to execution, not just the knowledge bit.
All right, I hope we've answered your question. Thank you so much for asking. Well, the headline when it comes to risk is usually who dares win, but I guess the message which comes out today is who cares can also win. You need to care about your investments, and if you do that properly, you stand a chance to win. Well, on that note, we will conclude this episode. I'd like to thank our guests, our panelists for coming on board and answering the questions, and of course the employees at Syntel Development Center for a wonderful exchange of ideas that we have had. And of course, thank you to our viewers for tuning in as well. Remember, you can stay updated with us on our website, NSEFinWiz.com, and our social media handles on Facebook and Twitter at NSE FinWiz. With that, we'll wrap up the show. Thank you for watching.
Well, I was worried about risk and loss, and this event really helped me in overcoming that fear. And now this knowledge is going to provide me a well-informed decision to take well-informed decision to invest into equities and stocks and everything.
It was indeed a very enriching experience, and it was very informative. And the best part is that I am a new investor. So it will really help me to improve my investing habits and plan my portfolio in a much better way.
After this session, what I have realized is that first of all, if at all I am planning to invest into something, then I should be focusing upon the risk factors, what is my risk appetite, and in addition to that, what are the different various financial products available in the market and the potential risks and benefit associated with each of the products.
Focus, ideate, innovate, enable.